Hi guys, welcome back to my video. In today's video, we're going over government bonds and how to use government bond yields in your analysis. This is the second video in a 10-part series going over fundamental analysis and everything you need to know about fundamental analysis in order to use it in your trading and to develop your edge further. First video made on interest rates, go check that out. I'll leave a card somewhere up here in the video now, which will really help with the understanding in this video. So first of all, what is a bond? A bond is a loan you give to a government, or it can be a company. You can get company bonds, and you can also get government bonds. But at the moment, we only really focus as traders on government bonds. We give a loan to the government in exchange for a yield, which you can see on the right hand side of the screen here. This is the bond yields. Now, at the moment in the US, by looking up the US 10 yield on TradingView, you can see we're currently at 4.346% in yields. And like a bank, when you gain interest from banking with a certain bank, it's the same thing with a government yield. A government will basically say for loading that government money, they will give you X% of your money every year. And in this case, it's 4.346%. In other countries like Japan at the moment, it's less. It's only 2.36%. And you can just look at that by looking at the different yields. So, why do we use them? Well, first of all, they're like interest rate predictions. When government bond yields go up, that you can see people and investors expect interest rates to also increase, right? And like what we know about interest rates, when interest rates increase, we expect currencies, like at the moment, DXY, to also increase. So you can see this positive correlation between bonds and also the currency price itself. This is the US dollar here, and this is the US 10-year bonds. And you can exactly see the exact same pattern here between when we bottomed here and now we've broken to the highs. Exactly the same with bond yields, right? So why do bond yields, why does the currency increase and get stronger when bond yields go up? Well, first of all, what you have to understand is why bond yields actually go up in the first place and why they go down. The fact is when bond yields are going up, that means people are selling bonds. And when bond yields are coming down, people are actually buying bonds. Why is this because? Well, first of all, when people are selling their government bonds, right, the government want to increase yields, okay? And when there's less people buying bonds, right, down here, nobody's buying bonds, it's just come down, the government has to increase their yields to make it look more attractive for people to start buying bonds. So so that causes government bond yields to increase. So people buy bonds when government bond yields are down. This is people buying bonds. And this is now when people start to sell them. And the reason bond yields go up, like I say, is to make it look more attractive for people to start buying government bonds. And then when people start to buy government bonds, the yields will come down because they're saying, well, we have people buying it, so we don't really need to keep increasing it. But then when it starts getting too low, here again, they'll start to increase government bonds. And that's because, people want to put their money in a safe place. And at the moment, what you can see in the current climate is it's really quite a tricky one to read because you have the dollar increasing, which because of the war, right? That's the reason why the dollar's got stronger, because people have taken their money out of risk on assets. This will be a concept I go through in later videos, and they're putting it into the dollar. They're putting it into the bank. Hence why the dollar's getting stronger. But people are actually selling bonds, right? Because bond yields are going up, and they're putting it into the dollar, like I say. So this is like sort of the things you can start piecing together to understand and build and generate ideas to why things are actually moving up and why things are actually going down. So when inflation is getting hotter, when inflation is getting worse, people are more likely to put their money in the bank. Why are they more likely to put their money in the bank? Because they need to pay for the more expensive oil prices at the moment. So they'll take their money out of government bonds, out of indexes like the S&P 500, out of gold, and they'll put it in the dollar. So this is why we can use it to sort of predict interest rates, because this is telling us that people are selling bonds and they're putting it in the dollar. You know, so they're putting it in banks where they expect to get higher interest rates. So this is why we can really use this, and bonds are what ultimately drives most markets. And if this is a really telling sign of how powerful they really are, because when we look at the pound gilts, the same thing, and then we look at the pound itself. Sorry, that's the euro. We look at the BXY. We can see the correlation here. Between the strengthening of the pound in correlation to gilt yields, to gilts as well. So it's really important that we use these first of all to say if yields are rising, the currency that we're trading is more likely to go higher, and interest rates are more expected to increase. So we can look at this chart here and say, okay, in the UK, we are more likely to increase rates than decrease rates, right? And then you can start pairing this with other websites like rate probabilities, like we looked up in the last video, and we can say, okay, yeah, that's pretty correct. We've got a 50% chance of a hike. It's quite a high percentage. So, that indicates that the pound will get stronger, okay? But here's the thing. Once you bring it into the context, which I'll go through in the next video, you can really understand different scenarios, how to use government bonds. Because right now in Japan, bond yields are going up, but why is the Japanese yen going down? And this is what I'll be covering in the next video, and bringing into the context around risk and the difference between growth versus risk-driven yields, and quantitative easing and quantitative tightening, and the difference between all these different things. But yeah, I hope you guys enjoyed this short video about what a bond is, how you can start using it in your analysis, and we'll delve further into the depths of bonds in the next video. But thank you very much for watching, and I'll see you in the next one.